Good day and welcome, learners. Today we are focusing on KMO6, which is KTO1, which is Cost and Management Accounting. My goal is to help you understand the cost language of manufacturing so that you can make better decisions on the floor and explain those decisions to management. Let's begin. By the end of this session, you and I would have explored the core elements of cost, compared the main costing methods used in production environments, and built up a clear understanding of budgets, how we plan them, how we compare them to what actually happened, and how capital and working capital decisions fit into the bigger financial picture. I'll keep the session practical and use examples from a typical production environment, and I'll also include many activities where we'll apply the ideas immediately. Now let's move on to elements of cost. I start by separating costs into product costs and period costs. Product costs are the costs that go into making goods, while period costs relate to selling those goods and running the company. We are taking a look at direct materials. When a material is physically part of the product and I can't trace its usage to a unit or batch without much effort, I treat it as direct material. Steel for stampings, packaging that ships with the product, these are all direct materials. If the item is consumed in production, but tracing it per unit is impractical, like lubricants, cleaning rags, or general purpose fasteners, I treat it as indirect material and include it in a manufacturing overhead. I make this distinction to keep product costing both accurate and efficient. If a person's time can be directly and reliably traced to the unit or batch being produced, I classify it as direct labor. Assemblers on line 1, welders working on a production order, or a machine operator assigned to specific run are typical examples. Support roles that keep production going, such as maintenance, stores, or material handlers, are indirect labor and flow into overhead. I use timesheets, barcode scans, or system job clocks to support that traceability. And now we are moving on to manufacturing overhead. Let's take a look. All the other production costs that aren't direct materials or direct labor fall into manufacturing overhead. This includes factory electricity, machine depreciation, small tools, indirect materials, indirect labor, and building costs for the plant. Overhead exists to keep the line running. Even though it isn't tied to one unit, it is essential to production. So I plan it, control it, and allocate it using an appropriate base such as direct labor hours or machine hours. Now we are taking a look at selling and administrative expenses, known as period costs. Costs that occur after production or required to run the business, such as sales commissions, advertising, delivering of finished goods, office salaries, and corporate services, are period costs. These do not become part of inventory. Instead, they expensed in the period. Keeping production costs separate from selling and administrative costs lets me analyze manufacturing performance without mixing in downstream activities. And now we are going to take a look at boundary cases and practical judgment. In real plants, I often deal with gray areas. If administration and the plant share a building, I allocate common costs. For example, property taxes. I use a rational basis such as floor space or head count. If a wage item includes allowances or benefits, I include it with direct labor when it's clearly traceable to units. Otherwise, I route it to overhead. The rule I apply constantly is traceability and cost-benefit practicality. And now we are taking a look at costing methods. I use different costing methods for different decisions. No single method fits every purpose, so I choose the one that best answers the question I'm facing. Let's take a look at marginal, which is variable costing. Short-term decisions Like pricing a once-off order when I have spare capacity, I look at variable costs per unit, direct materials, direct labor, and variable overhead. If the selling price is above the marginal cost, the extra units contribute to fixed costs and profit. Note, I do not include factory overhead in this unit decision because in short term, it doesn't change with one more unit. Now let's take a look at absorption, which is full costing. Need inventory valuation or cost of goods sold for external reporting, I use absorption costing, which assigns both fixed and variable production costs to units. Each unit absorbs a share of fixed overhead, usually via a predetermined overhead rate. This keeps financial statements compliant and ensures inventory carries its fair share of production costs. Taking a look at standard costing and variances. To drive control and continuous improvement, I set standards for materials, labor, and overhead. How much do we expect to use and at what prices under normal conditions? Then I compare actual results to standard and analyze variances. For materials, I focus on price and usage. For labor, I focus on rate and efficiency. For overhead, I focus on spending and volume. I treat variances as a signal to investigate and not as blame. And now we are taking a look at historical, known as actual costing. For recording asset acquisitions and past transactions, I use historical costs, what we actually paid. This is objective and auditable. Keep in mind that the historical amount may differ from today's replacement cost, but it remains the foundation for accounting records and depreciation. Now let's move on to uniform costing and lean costing. When multiple plants or companies agree on the same costing principles, I refer it to uniform costing to make fair comparisons and set transfer pricing consistently. In lean costing, I aligned reporting to value streams, reduce complexity, highlight flow, inventory turns, and lead time so teams can see the financial impact of waste reduction. Consider a bracket that uses 20 Rand of steel and 5 minutes of assembler time at 240 Rand per hour. Variable overhead is 5 Rand per unit. Fixed factory overhead is 200,000 per month at a capacity of 20,000 units. Marginal cost per unit equals 20 materials plus 20 labor plus 5 variable OH equals 45 Rand. Absorption cost per unit adds the fixed OH share, which is 200,000 divided by 20,000 equals 10. 45 plus 10 equals 55. If a once-off order offers 50 Rand per unit and I have idle capacity, I accept because it contributes 5 Rand per unit towards fixed costs. For regular pricing and inventory, I still use absorption costing to reflect the full cost of production. With methods understood, I turn to the budgeting process, the day-to-day tool that connects plans with performance. Let's take a look. A budget is a quantified plan for a period. I use it to set expectations, coordinate departments, and hold all of us accountable to achievable targets. I structure simple and logical so that my team can follow it without a finance degree. Now let's begin with income and expenses. I begin with the sales budget, quantities multiplied by expected prices. From there, I derive the production budget, then materials and purchases budgets, the labor budget, and the manufacturing overhead budget. I also prepare selling and administrative budgets, which are period costs. Splitting these streams, keeping our product cost analysis clean while still forecasting the total income statement. Now let's move on to overheads and production costs. In the manufacturing overhead budget, I separate variable elements from fixed elements. I select a sensible allocation base, direct labor hours or machine hours, and compute a predetermined overhead rate for this period. This rate helps me cost jobs consistently, monitor absorption, and avoid month-end surprises. Let's take a look at projections versus actuals. Each month, I compare what actually happened to the budget. I explain the differences using price, efficiency, volume, and spending variances. When I see an unfavorable materials usage variance, I investigate scrap, rework, training, or process capability. When I see a labor rate variance, I check overtime patterns and grade mixes. The point is to learn and adjust next month's plan, not just assign blame. And now we are taking a look at capital and projects expenditure. When we invest in long-term assets, like a new CNC machine or an expansion, I treat it as capital expenditure. It does not hit the income statements all at once. Instead, it capitalized and depreciated over its useful life. Before I approve or recommend CapEx, I consider payback, NPV, risk, and the impact on throughput, quality, and safety. Also plan for commissioning time, training, and initial spares so that the asset delivers value faster. Now let's move on to working capital. Working capital is the cash tied up to an inventory plus receivables minus payables. As a supervisor, I influence it daily. I reduce work in process by improving flow, cut cycle times by reducing changeovers, and limit overproduction through level scheduling. Better first pass yield and fewer defects lower than the inventory we need to cover uncertainty. These operational moves free cash without cutting capability. And now we are taking a look at guided build mini master budgets. Together, we can construct a smaller master budget. It starts with the sales forecast, calculate required production, plan materials usage and purchases, estimate direct labor hours and cost, and build the overhead budget. We then pull the numbers in a projected income statement and a simple cash view. It highlights where supervisory action matters most: scrap reduction, rework avoidance, overtime discipline, and schedule adherence. Let's move on to variance demonstration. I adjust one output, material price using 6 Rand per kg or using slipping from 2.0 kg to 2.1 kg per unit, and we compute the resulting price or usage variance. Link each variance to likely causes and realistic corrective actions that a production supervisor can lead. We've now covered the essential building blocks, which are cost elements, costing methods, and budgets. So now I connect the dots to your assignments. Let's take a look. You will be asked to define cost elements precisely, select an appropriate costing method for a scenario, and sketch or interpret a simple master budget. I advise you to use the same wording and logic we've practiced. Rely on traceability for classification, match method to decision purpose, and explain variances with price, efficiency, volume, or spending language. On the floor, I expect you to apply this immediately by tightening data capture, making waste visible, and participating actively in monthly variance reviews. We have now reached the end of this session, and we are going to see everything that we've covered so far. 1. Elements of cost: direct materials and labor, manufacturing overhead, and the separation of product costs from selling and administrative period costs. 2. Costing methods: when to use marginal versus absorption, how standard costing drives control, what historical cost records, and how uniform and lean perspectives support compatibility and flow. 3. Budgets. Constructing sales, production, materials, labor, and overhead plans. Comparing projections to actuals through variance analysis and understanding capital and working capital in day-to-day terms. I appreciate your engagement. Thank you for your participation and attention today. I will see you at the next session.